In this episode of Investors and Operators, I am doing a long-awaited, much anticipated recording with Doug and Jim from Princeton Equity Group. Guys, I think I've done 3 episodes with 3 different portcos, but this is, I probably should have done it in the opposite order, but we'll roll with it. It's awesome to have you here. And here are some of the topics that we'll be going through. Like first, what do you do? What's the journey that you have been on from an independent sponsor to now at Fund 2? What are some of the bumps in the road along the way? What advice do you have for independent sponsors who are thinking about going the funded route? Then we'll switch over to things that are related to the sellers, founders, owners, friction points. How do you have a successful relationship? And a whole lot more. This might be 2 episodes, but we'll see what we can get going. I'll turn over maybe to Doug, if you wouldn't mind, just kind of giving the background, maybe 60 seconds on what is Princeton, what do you guys focus on? And then over to Jim for how you guys came together.
Yeah, well, thanks, Jordan. It's great to be on. And so Princeton Equity Group, we are a private equity firm based in Princeton, New Jersey, and Dallas, Texas. And we focus on investing in typically founder-owned franchisor and multi-unit companies only. That's really our focus. And as a franchisor, many people know what a franchise business is. People think of McDonald's, Burger King, et cetera. We focus really on services-based businesses, and the business model of a franchisor is the franchisor is the one that sells the franchise license to the franchisee. They collect an upfront license fee, and they use their own money. The franchisee uses his or her own money to build their location. Many franchises are not a physical location in terms of home services. Many are a physical location. And then when that business is up and running, the franchisor collects a ongoing royalty in exchange for a lot of support, marketing help, technology help, coaching, education, things like that. So that's really what we focus on. We're manage about $1.2 billion of capital and are on our second institutional fund, and we have 22 people, including 3 operating partners.
Well, what's the story, Jim? Kind of how'd you guys meet, and what's the journey as an independent sponsor that you made before raising the first fund?
Yeah, so I've known Doug for 22 years. It's been an amazing time together. We joined a large private equity firm in Boston as very young people, and really became fast friends. And Doug left and went to business school, and then a couple other firms. I left that firm and then eventually started our predecessor firm, Princeton Ventures. But through that entire time, we stayed in really close touch. And we're always talking about investing, doing something together. And one of the great things is that that came to reality in 19. We had done many investments together in franchising before that, but we were kind of doing them each through our own entities or at our prior firms. And we kind of made things official. And, people always say, don't do business with friends and family. Doug and I went in a very different direction. Doug and I are very, very close friends. And I highly recommend getting into business with a good friend. It can be a really wonderful way to spend time.
I'm very familiar with that. My spouse is my business partner.
You're loving it now.
Well, that they say you should never do. That
it's interesting. I'm curious kind of how your journey has been, because with us, it actually made our marriage better and stronger. Because the first business we did this before this, which failed, like Jing was at home and, paying bills as a lawyer while I'm just off in startup land, and all she sees is the bank account going down and to the right and getting irregular updates on what's actually happening. And so like our whole we were living parallel lives as a banker and a lawyer, and we happened to sleep in the same home. and we happen to have a kid together. Like it was completely parallel, but our business took an exponential jump when we actually came together. So what was it like for you all kind of navigating maybe difficult discussions and who does what in the firm?
Yeah, I would say the transition from being sort of apart to formally together was a very, very easy one. And we tell some of our investors this, that they ask a similar question. And because in a way we've been doing this for 20 years, we've co-invested together, we've been in separate locations, we both sort of trained at the same firm originally. So it has been, I think we are better together than we are apart, right? Like Jim was sort of doing something on his own. I was sort of doing something, very entrepreneurial, but we're better off together. And I think the other benefit is, you get sort of one life to live, and there's a lot of things that we're going through together professionally that it's super fun to have somebody to go through that together with. We have a lot of, we have a lot of inside jokes. We can, if there's a big challenge, we can sort of look at it the same way. It's just nice to have sort of somebody there in the, in the trenches with you to share those experiences. So that's been a huge benefit over the last 5 or so years.
Well, with in 5 years, there have to be some bumps in the road. Like, are any that kind of come to mind is kind of how you navigated them so that people who are listening to this, who are, maybe, facing that right now, that they can think through it?
I'll let Jim respond to that. The only thing I would say is before you go into a situation like we're in, I think it's incredibly helpful to have professional respect for the person that you're going into business with. Because I think it just like a marriage, I suppose, it does make whatever those difficult situations are a lot easier. And you also have alignment on what you're trying to create together. So I think a lot of the building blocks happen before you even open the doors. And a lot of people open the doors when they shouldn't open the doors.
Yeah, I think that's really well said. The other thing that's really unique about the way this came together is it was almost like we had a very long engagement. Doug and I had a 15-year or more engagement where we really got to work on the friendship first. And while we were doing that, we were doing deals together, kind of voluntarily doing things together. Which means that now that we're officially together, we've been officially together for about 5 years now. I want to create some drama here, Jordan, for your viewers, but there's no drama. Like, I actually cannot think of a time where Doug and I saw the world differently when it came to an investment decision, when it came to a business decision around how we're growing the firm, when it comes to thinking about, do we hire an additional person? Do we not hire an additional person? If we grow the team, what are the needs that, like, all of these things, we get very quick consensus on. And one thing I tell people, which is surprising to a lot of folks, is we're almost interchangeable. I mean, we really don't have a lot of division of labor here. Doug could do a meeting, I could do a meeting, right? Doug could work on a particular investment, or I could. And chances are the outcome would be very similar, whether Doug led the deal or I led the deal, because we so often think and act very similarly.
Well, what advice do you have for independent sponsors who are considering to raise a first fund, and people who are in the middle of raising that first fund but are struggling?
So what I would say is that, and this is a challenge for a lot of independent sponsors, is you not only need a track record, but you also need a team. And it's virtually impossible to raise a fund without both of those things. And we were very lucky in that we were able to build the team and the track record really over a 10-year period before actually coming together very formally. And today that track record in franchising is very strong. We've done We've backed over 35 concepts, and we've got really, we think, the leading track record in growth franchising in the country today.
I would add to that. I think it's important for somebody to, one, know that it's very hard. You're going to meet hundreds of people, and hundreds of investors will say no. Like 90% of them will say no. I think statistically that's about where it is. Um, Second thing I would say is it's really important to have the why. Um, you have to be able to explain to an investor on an elevator why you want to raise a fund. Just like somebody who's asked, why do you want to be president of the United States? You have to have a succinct, essentially one sentence answer. And I think we had that. We have that. But that goes a long way because there are so many funds in the market. You have to be able to explain very, very quickly why you're different. And that goes a long way with investors. The other thing I would say too is, as an independent sponsor, if you've been a successful independent sponsor, you have a leg up in fundraising because you've already been doing it. It's a great training ground for actually institutional fundraising. And we had that as well. Like Jim and I had done that probably hundreds of times with investors that ultimately, a lot of them said no to us, but we had those reps. So don't lose sight of that. I think have the confidence to know, like, if you raise money for deals, you can probably be successful.
Shifting over to deals, I'm curious because you guys have done, 30, 35 concepts, you have enough data points to see what goes right before a deal and what goes wrong before a deal. What practical advice do you have for sellers who are considering to sell within the next 6 to 12 months about what they can do, what they can expect from a successful transaction, and also what they should not do, and the red flags and things that they can just do now? And maybe it's false expectations about what it actually looks like, but y'all have seen it 35 plus times. What are some of the key pieces of advice that you have?
Well, one piece of advice is that it's very hard to time the market. And the time to raise capital or bring on a partner is actually when things are going really well. So I think the mistake a lot of entrepreneurs make is they kind of wait until the chip count gets really low at the table before they think about bringing on a partner. And that's the moment where actually no one will want to invest. So you have to go to market from a position of strength. Along that, so what does that mean? Well, it means that the numbers are really good, and it's sort of all the numbers are pretty good. It's not just revenue, it's not just EBITDA. It's actually getting into the next level of metrics and making sure that if it's a franchisor model, that the franchisees are doing very well, that they're validating. Same-store sales are healthy. You kind of need to have a package of excellence in order to attract a high-quality partner in this day and age.
And is that because it's just going to be a very difficult conversation if numbers are not, and they're going to not get what they expected, and it's going to be a very tough gap to bridge between the new potential owner and them?
Yeah, what happens is in these things where there's a lot of um, expectations that aren't met, that is often where the leverage can shift in a negotiation, and it will then shift in a way that the buyer actually has a lot more leverage than the seller, because there's weakness from the seller. So if the seller is sort of saying, hey, this is a great business, our franchisees are really happy and healthy, and that turns out not to be the case, well, whatever the valuation discussion was when that buyer thought things were really rosy, the valuation expectations, the structure, the deal terms, all that are now totally reopened to negotiation. And that can be a scenario where you have big mismatches between where the expectations were, where the reality was, and that often leads to a deal breaking, not alone getting done at a lower value.
Yeah, the only thing I would add is I do think Jim and I talk about this all the time. It's important for the company's management team, let's say the founder, to do their own due diligence. Everybody always talks about the private equity firm's due diligence and hiring a bunch of advisors and looking at the numbers and all that kind of stuff, which we definitely do, as does everybody. But if it were my brother-in-law who was going to take on a private equity partner, I would say, look, there's a lot of private equity firms. They all do look and sound the same. You go to their websites, they all have capital, but they are very, very different. And so it's incumbent on you to do your due diligence, talk to other CEOs they've worked with, talk to other founders, call around and see what they're like, because you're going to be working with these people. We have calls every week with our management teams, often board meetings and just impromptu meetings. You're stuck in an airport. I mean, you're going to have to like these people, and you're going to have to really understand, are they good at their job? Like, are they good investors? Right? You want to partner with somebody that's really good at what they do, in part because you just want to be sort of in bed with somebody that's good at their job, but also you're going to be rolling equity probably in Newco. And I don't want to put my money next to somebody that has a abysmal track record, because if they turn $1 into $1.20, that's not so great over 5 years. I want somebody that turns $1 into $4 or $6. So that, I think people just don't think about that and focus on it, but it's immensely important. So it's kind of subjectively, emotionally, and also like truly objectively, like financially.
So let's dive a little bit deeper into that question. What do sellers need to ask, maybe in terms of order of operations, to diligence a private equity firm? What questions if they're having a call this week with a CEO of one of the portfolio companies, how should they spend that 30 minutes to diligence a private equity partner? What questions do they ask, and what do they don't ask?
I would say that I would encourage that person just to ask, what's it like to work with such a private equity firm A? Who do you work with? Was it the same group of people at the beginning, the middle, and maybe at the end? When you went in, did you have a shared vision, and did that private equity firm deviate from that vision? Was there any kind of bait and switch that occurred? Private equity firms have a bad reputation for that. Could you trust the people on the other side of the table? Do you actually feel like they added value, and specifically where? Would you do it again, and why? What were the biggest hurdles that you faced as partners, and how did you overcome them? The honesty and transparency. We like to say to our CEOs, like, please, if there's bad news, let it travel fast. Like, you run a high growth, complicated business with dozens or hundreds of employees and dozens or hundreds of franchisees all across the United States. We're not naive. Like, it is hard. That's hard. There are problems. So let's talk about them. Like, I think, and I think you want a partner that is okay to hear some of those things that you're wrestling with. So,
Jim, what are some things that you might add to that list?
Yeah, if I were an entrepreneur interviewing a prospective private equity partner, I would absolutely want to know what they do to help. Just writing a check in this day and age is not enough. You can get so much more value out of the right partner as an entrepreneur. So I would ask what they do to help, and then ask them to walk through some case studies. Pick a few companies on their website and ask them, well, what did you do at this company? What did you do at that company? How did you act when things didn't go well? I would ask, have you ever replaced a founder or a CEO at one of your portfolio companies, and why? And then I do think it's really important to drill down on your prospective partner's track record. Do they know the industry? How do they prove that? Well, did they back a lot of the marquee growth names in that industry over the last 5 or 10 years? Have they ever lost money in an investment? How come? It's, I think, really important that if you're going to be rolling over some of your equity as a seller into a partnership with a private equity firm, that capital that you're leaving behind is well looked after. And there's a wide variety of returns that private equity firms can generate, from losing money to making a lot of money. And what typically happens is that firms get pretty good at one or the other. And you really want to make sure you're in bed with a partner that is really good at generating returns.
I love it. Well, I think that's a good place to end. And then we'll pick up an episode 2 in the near term. Guys, I appreciate your time with this.
Thanks, Jordan. Great to see you.